Hi there everyone, good morning and welcome to this edition of The Market. I'm Avan Dabash, with me Nikunj Dalmia as well as Anisha Jain, and taking stock of what's going on across the globe. And it looks like we put the brakes on that gaining streak, at least when it comes to Wall Street. So clearly after 5 straight days of a smart rally that we've witnessed, most of the indices seem to have lost ground following that Fed announcement. You had the S&P 500 as well as the Nasdaq that snapped 5 consecutive days of winning, and the Dow Jones as well was mildly flat. Clearly, you had the Fed minutes, which pointed towards, as of now, no hint of rate cuts coming about. And taking a look at that revealed the policy that they have maintained the monetary policy had to be restrictive, and as of now, very little appetite for rate cuts. So that's really the overnight move on Wall Street. You've also got the Asian markets this morning that are looking a little bit mixed this time around. And for the most part, you've got the likes of Kospi as well as the Hong Kong index and China, which have moved on the back foot. So a restrictive Fed policy, Nikunj.
See, it appears that there is no rate hike around the corner, but it also appears that no rate cut also is around the corner, which means it is pretty much going to be status quo. And from a financial market standpoint, as long as markets are able to predict whether rates are going to move higher or lower, they will adjust. Markets don't like surprises. So there is nothing in the FOMC meeting which could be called as a surprise. Global cues, while the run-up in the global market from end of October, from early November actually has been quite linear. Markets sometimes find a reason to just correct, just a little bit of chop and churn here or there, nothing scary. So I will not use the word bad to describe the global setup, but I would say global cues are a bit soft. Can Indian markets move independently of what is happening in the global markets? I doubt it very much, because frankly the common ledge on which markets in the month of November have rallied is largely global macro. And if global markets they get jammed, it's safe to assume that Nifty, which is already looking jammed, is going to further either consolidate or is going to just spend time in a narrow range. So from a oversold zone, Nifty made a comeback. There was bout of short covering. It appeared a couple of days ago that Nifty was ready to gain some kind of an elevation, but looks like it's going to be back to square one, where we would be using phrases like the party in small cap continues, mid cap continue to outperform, and Nifty continues to languish. I think we are again going to that same rhythm of the market.
Yeah, looks like it, because the market yesterday also managed to just consolidate. 19,800 is something that we did not manage to sustain as far as Indian markets go, and the Nifty has managed to actually snap the losing streak. We did see a gain of almost 100 points at the Nifty level, but it was very, very range bound during the trading session, and overall the range for the trading session itself was limited to just around 100 points. It was Reliance, that heavyweight was up around 1.5%, and HDFC Bank too managed to gain almost 0.7%, and that's the reason you saw good gains on the Nifty. Nifty Metal also saw reaching those 1 month high levels on back of the fact that dollar index has cooled off substantially. It's now around 103.6 thereabouts. Pharma, real estate, these are two areas of strength in the market right now. Look at those rallies that we have seen in the real estate stocks, many of them sitting at all-time high levels. So that is what is supporting one end of the market. Having said that, it's Nifty Bank which is the problem point for the markets right now. Continues to underperform by a huge margin, and even if you look at the trends coming in from FNO, Nikunj, it says that perhaps there was fresh longs as far as Nifty is concerned, and for Nifty Bank there was only short covering. There's still not conviction to go fresh longs as far as Bank Nifty is concerned.
No, Nisha, I mean, the Bank Nifty in a sense is just getting jammed, and it's getting jammed now because of technical factors. Technical factors are largely FI selling. And this is a sector where the ownership levels are high. So most of the funds, most of the schemes, most of the global allocators, they overweight financials. So if you're already overweight a sector, you cannot just go supremely overweight when the benchmark is, so the composition of financials, including NBFCs and insurance and other sectors, I guess for most of the big funds and PMS schemes is anywhere between 25 to 35%. Very few funds actually have a underweight positioning on banks. So when a sector is underperforming, either you need a fresh buyer to come in. That fresh buyer cannot be domestic institutional investors, because they're already loaded up. Then you got FIs which are selling, so supply seems to be emerging. So when there is no fresh buyer in the town and the existing investors who are getting flows, they do not have the appetite to add more into banks. I guess the sector goes through a technical patch, so to speak. Then on top of that, you've got the RBI, which has raised concerns on unsecured loans. The NIMs are coming under pressure. So then markets are saying that, okay, there is selling. The numbers are not going to be that strong in terms of the near-term profitability for next 2 or 3 quarters. Let interest rates settle down. Let things settle down on the global front. Let flows come back, and then maybe banks will start participating. The sheer value and the sheer earnings delivery is not really driving some of these banks higher. Since it's a large sector, it will only move higher when you see either flows moving or when you see something substantially changing on the momentum front, which I'm afraid is not changing.
Flows or something on the momentum front. Otherwise, nothing is really going to move the needle when it comes to some of these banks. But that aside, one can't ignore the kind of moves that we're seeing within the broader markets, in particular the small cap index perched near record highs. And interesting data that we've culled out as well with respect to the small cap to Nifty ratio. The fact that it currently stands at about 0.7%, it's the highest since the year 2018, but it's still below the 10-year high of about 18%. Nikunj, the fact that it's above those pre-COVID levels, what exactly is this indicative of?
See, there is this, the most talked about narrative in the market is that, okay, there is a bubble and there's a trouble in the small and the mid-cap stocks. And you may say, okay, there is. But not everything in the small and the mid-cap space, I guess, could be called as expensive. Yes, sliver of the market offers value, but sliver of the market, I think, is also in that bubble or trouble category. How do you look at this graph, and what is the explanation of this graph? The small cap to Nifty ratio. And if one really looks at the rallies which the small and the mid cap indices have done, now this is a self-explanatory graphic which is there on your screen, but if you flip it around and look at the small cap rallies, and this is pure maths, and we've looked at last 4 instances, the mid cap rally actually is really at a median level. Between 2009 and 2010, when markets were coming from the crisis of GFC crisis, the rally was 42%. The real bull market rally between 2004 and 2007, 100% plus. 13-17, the bull market rally 87%. Now, to put things in context here, the current rally from the COVID low, small cap to Nifty ratio is only 69%. So even based on historical numbers, it is not that this time around the mid-cap rally has been outlier, and the mid-cap rally in a sense or the small-cap rally in a sense is something which is very scary. I look at the framework in the following manner. Sliver of the mid and small-cap stocks offer value, but sliver of the market is still in bubble territory. So there are 2 extremes, and that is why you have to avoid. With each passing day, the value is getting eroded, and with each passing day, the bloating in the mid and the small-cap stock is starting. But I don't think it has become a time bomb that it's tick, 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 and it's going to blast.
So seeing a bit of bloating, there are extremes in the market which are getting frothy and punchy, but can't put a generic line to it because there are still pockets which look interesting from the small cap and mid cap space. But shifting back to what's happening across the globe as well, and those Fed minutes did impact the moves that we saw in the US markets as well. What's the read-through for India and what should we look forward to? Let's welcome on board Steve Englander from Standard Chartered Bank to talk to us just about that. Steve, hi, good to have you on the show. Good morning. Thanks so much for making time.
Always a pleasure.
What was your read-through of the Fed minutes that we got overnight? Expectedly hawkish?
Well, I'd say mildly hawkish. The numbers hadn't really turned by the time the FOMC meeting came around at the beginning of November. So it would have been looking at the subsequent data had they come through as a really dovish kind of statement because inflation was weaker, activity was weaker, and so on. What I took away was actually quite a divided Fed. That many of the statements were kind of factual. Several saw weakness or risks of weakness. Several saw risks of strength. But there seemed to be little consensus on which way things were going. But I think subsequently with the weak inflation numbers and with some indication that the economy may be weakening, the the actual stance may be a little bit more dovish than came across through the minutes.
So, what is next now? Because what markets want, Steve, some would say, is predictability. Are FOMC meetings throwing enough and more light in terms of predictability of interest rate curve?
Well, we've gone from debating, whether they're going to hike once or twice more to being pretty confident they're not going to hike, and debating when they begin to cut. I think that's about as much predictability as you get. What I think the risk for markets is that the cuts that are priced in are really contingent on the economic data weakening, that the unemployment rate keeps going up, that non-farm payrolls keeps going down. We haven't changed our forecast yet that the Fed begins to cut around mid-year, because we're waiting to see more concrete evidence that the economy is indeed slowing down. Were that evidence to occur, I mean, we'd have to take it on board. But I think that for now we've seen the reversals in the past, and we're a little bit cautious about changing our views.
Outlook, Steve, on the inflation trajectory, the fact that there are worries looming large that it could continue to remain stubborn, as they've described it, or continue to move higher. Would more need to be done down the line, according to you, in order to alleviate the inflation concerns?
No, we don't think that they have to hike more. I think that the risk of a hike is sort of further down the road. That say inflation continues to come down, but stalls at around 3.25 and just isn't going anywhere, not going higher, not going lower. Down the road, the Fed might say, look, we have to do another hike or two to get it back moving down towards where we want it to go. So I think I don't think there's a risk, or a big risk, that it's going to explode. But I think that there is a risk that it could stall. And if it did stall, the Fed might have to do more hikes. That's not our forecast, but it's certainly a risk scenario.
Taken, Steve. On that note, we'll let you go. Appreciate you making time and speaking with us. But let's continue with the theme of the commentary we have been getting from across the globe. Vinny standing by with that list.
Good morning, and absolutely in terms of commentary, obviously other than the FOMC meeting which we just discussed, was European Central Bank's Christine Lagarde is actually highlighting that they need more clarity in terms of the fiscal policy and where that is headed to set the monetary policy tone as well. And obviously, furthermore, quoting her, says that if they don't know where the finance ministers are headed from here on in terms of the fiscal point of view, then it's difficult to set out the monetary policy as well. So that's the word that is coming in from ECB's President Christine Lagarde. Now, other than that, we have BOE's man who's talking about the further upside potential that they see in terms of the sales and employment. They see strong wages, service inflation through 2024 as well, and high inflation risk, which is something that is influencing the wage setting up going forward as well, is what they're expecting. The policy only recently had become more restrictive and not by much. So that is one they are highlighting in terms of the policy coming in, and more inflation likely to continue in 2024 is what they're believing. Lastly, we have a tweet that is coming in from Mark Mobius, and this is quite interesting in terms of how he is finding terrific opportunities and a new pathway in terms of the investment that he's making by using AI to identify investment prospects, and particularly in tech-focused companies within the emerging markets. So using AI to find out some opportunities is what Mark Mobius is doing currently.
Thanks very much, Vinny, for highlighting the global view. Let's talk markets and levels then. And Kunal and Naresh joining in, as always, our chartists. And Kunal, let's get in a sense from you then as to what exactly you expect is going to drive the markets higher from the current levels, perched at about 19,750 plus.
So, I think it's definitely a momentum-less market, but it's not a direction-less market, at least in terms of the last 2 weeks, 3 weeks of price rally which you've seen. We're definitely moving up higher on the Nifty. But yes, I think on the other hand, there have been few sectors which have on and off participated for the index. And I think that's acting as more of a reason why the index gets into that pause or lack of strong momentum on the upside. Very recently, for example, the Bank Nifty and the Financial Services Index, I think they've started to underperform. Even the Nifty IT Index has gone to a bit of a stall for itself. So I think that could be maybe one of the reasons why you've seen the gains on the indices on a very slow and steady on a gradual note on the upside. However, yesterday we managed to come back to that 19,800 mark on the spot levels, even though I think in terms of closing basis, we could not give a decisive closing about the 19,800 levels. But I believe that sooner or later, if we manage to close about this 19,800 mark on the Nifty, we could be looking at a strong breakout in terms of, hopefully in terms of momentum as well.
Okay, what about you, Naresh? What's your view on the markets? Is there any interesting trade?
So as of now on the markets, the view is we are still stuck in this tight band. The one thing which has changed yesterday is the fact that Reliance Industries made a little bit of an up move, crossed a 2-month high. So if it can take leadership from here and go towards 2,500, 2,550, which is a possibility, that could propel the markets, the Nifty at least on the upside. Same thing on the banks. We are not seeing a similar move as such. We are not seeing any follow-up price action beyond a day or two in the heavyweight. So for now, the view remains we will be in this tight range, and we could head higher only with the help of Reliance Industries as such.
Waiting for that big move on Reliance Industries, but let's get stock specific and get those ideas from our technical experts as well. Kunal?
So IEX is the first stock which I would suggest as a buy. I think after yesterday's price action move, the stock crossing about 140 mark. I think what I like about the chart specifically is the stock breaking past about a parabolic SAR resistance, which I believe is a key towards possibly a revival of a trend for the stock. So would suggest a buy with a target of 155, stop loss at 134. And the second would be a buy on Tata Steel. This is more of an anticipation that the stock would get into a breakout mode. Over the last 1 week, the stock has been showing some signs of revival, heading back towards a breakout of 125. So I believe that over the near term, the stock has potential to come back towards 130, 135. 134 is whatever place as a target, stop us at 122.
What about you, Naresh? Any interesting chart trends that you are spotting?
So first is a buy on Ashok Leyland. The stock saw a little bit of an up move and a small range breakout yesterday. Could see follow up today and head up to the previous highs. The stock has been consolidating around that 165, 170 mark, which was the previous high. So retest of the breakout is done. Yesterday's move indicates a flag breakout or a downward trendline breakout. We could go back and test the recent highs of 190, 192. Stop loss to be placed at 173. Second is a buy on NHPC, which did give a big breakout above that 47 mark, went up to 57, then consolidated, retested 48, 49 levels, and has now started making a comeback. Yesterday hit a 2-month high, a short-term breakout, as well as volumes were 2x the normal volumes, expecting it to cross into 52-week highs and all-time highs. A stop loss at 52 and a target price of 65.
Okay, there you have it. Those are all your top technical recommendations, but stocks as well that we'll be keeping on our radar that we need to watch out for in today's trade. And we've got Somit here to discuss just that. And Somit, let's begin then by talking about the cable players, because we've got a Goldman report and KEI and Polycab are on their radar.
Well, yes, they have initiated coverage on both the stocks. But one thing to remember here is that both Polycab and KEI, both the stocks have doubled year-to-date basis. RR Cable has listed, that has also gained around 50% from the issue price. And then there is Finolex Cable, which has managed to gain around 68%. But they have their own management issues, and hence the run-up has been a bit low on the lower side. And on the valuations, if you see, both RR Cable and Polycab are trading more than 40x their valuation. It's KEI Industries and Polycab which are trading at more than 40 times their value, 12-month forward valuations. Now, what Goldman Sachs here is saying that they're expecting the company to grow at least 2 times the GDP going forward, and that is all on the back of the capital expenditure that the government has doing, the pickup in real estate that they're seeing, and also they are expecting electric vehicles pushed also to contribute more to sales of KEI Industries and Polycab going forward. Now, they're preferring Polycab over KEI, and hence they have a buy rating on Polycab and a neutral on KEI, is the fact that Polycab has a larger distributor base. But one thing to notice here is that even with a buy rating, the potential upside for Polycab is just 8% over the next 12 months. So given the fact that the stock has run up, even I guess bigger brokerages like Goldman are finding it difficult to ascribe a higher target price to Polycab.
Okay, I'll tell you what, let's look at KI Industries and let's not look at the Goldman Sachs report. I just want to make this point, and this is like a long-term benefits of long-term investing. Look at the 10-year graph or a 5-year graph of KA Industries. And anybody wants to guess that what return KA Industries has given in the last 10 years? It has to be a big number. Let me just drop a hint.
10,000%.
Wow.
35%.
Just read the numbers, please. 35843.
Yeah.
How much is that?
Right.
35843. That is the kind of return the stock has given in last 10 years. And 10 years is not once upon a time. 10 years is not some era or a different regime. This is the kind of return KI Industries has given. For a company which was trading at a P multiple of 8 or 9 times is now commanding a P multiple of 40 times. Now, the large part of the gains actually have come in the last 5 years, not the first 5 years. But the cycle has turned. For a stock which was unknown now, is now part of everyone's portfolio. 8 rupees has become 3,000 rupees. Now, what was wrong when it was at 8 rupees? Well, the sector was not blooming. Now the sector is blossoming. Similarly, Polycab. I mean, it went public late, but post-public, it really had a puffy-duffy kind of a relationship with the market. There was COVID uncertainty. And if you look at, Polycab, the numbers, I think, have just been absolutely amazing. Now, here's my understanding of the business. Look, I think I agree with the Goldman Sachs report. The top line, the entire, trust in terms of macro, government initiative, power, cable, all these are sectors where the capex is going to be very strong. But are we discussing what was yesterday's trend is tomorrow's story? Well, this could be tomorrow's macro trend, but these stocks are unlikely to be multi-bagger from years because there is a cyclicality after 2 or 3 years which will kick in. These businesses are not very strong in terms of return on equity and return on capital, and large part of the re-rating is over. So if you own these stocks, please hold them. But if you plan to buy these stocks, you got to be prepared for a 15-20% volatility. And I think to assume that you will get more than double-digit returns on a CAGR basis from here also would be slightly stretched. These were stocks which HNI investors bought into when nobody wanted to buy them. And now they've become part of everyone's portfolio. So best part of the discovery process is on. Best part of the P expansion is over. Now you have to ascribe only earnings growth, which could be anywhere between 15 to 18%. That's my limited point.
Okay, but that's the clear conviction call
8 rupees has
coming in.
become 3,000.
Yeah, that's just a very, very wild and crazy number to look at.
And Goldman Sachs is coming out with the report now. Where were they earlier?
So they finally initiated coverage a little late to the party, but nonetheless they are expecting for the macro trend to really continue. But of course the big point is that do not correlate with the stock expectation as well in terms of returns, because it's unlikely they could have a deja vu kind of moment or not. But what's glittering in the trading session is of course Titan. It's not only trading at the all-time high level, it is also past that coveted mark of 3 lakh crore in terms of market capitalization, Sumit.
Well, in fact, they have been adding 1 lakh crore every 2 years. They touched the 1 lakh crore cap in 2019. In 2021, they touched the 2 lakh crore mark, and currently in November 2023, they have touched the 3 lakh crore mark. Now, what has been aiding growth? It is the store expansion, which has been the main reason or the bedrock for growth, as CLSA had quoted yesterday. Apart from that, it is the fact that the luxury market in India is breaking out. People are moving towards premiumization, and that has been also aiding Titan because it is present in all the premium categories, be it gold, be it luxury watches, or be it eyewear also going forward. Apart from this, the company is expanding in the international market and also in the jewelry business and also in ethnic wear and in fragrances. So these are the couple of expansion growth target expansion mode that the company has in fact going forward. So that is one thing that people are bullish on, and given the fact that the company has proven its track record in the past, what CLSA believes that one needs to pay premium for owning Titan. Now currently it's trading at a 70x P, which is slightly higher than its 5-year average, which stood at close to 64x. And even CLSA in its note says that given the fact that the growth rate has been strong for Titan, people need to pay a premium to own Titan going forward. Nikunj, how do you see Titan growth trajectory going forward, and do you concur with what CLSA says that one needs to pay a premium to own Titan?
See, whether Titan made Rakesh Jhunjhunwala famous or Rakesh Jhunjhunwala made Titan famous, you don't know. But the bottom line here is that here's the story which in a sense, which was discovered. I mean, it has just been such a classic compounder. And all you had to do just keep the faith going and ignored what was thrown at at investors in terms of it is an expensive stock and the P multiples cannot expand. But time and again, the stock has delivered. Just think about last couple of years. I mean, there was COVID and before that, there was demonetization. And for a company which can survive these two stormy factors, which could have shaken up their core existence, what happened to demand during the COVID time and what has happened to demonetization and impact of that in the jewelry market. But Titan has managed to withstand that. Very powerful message I think from the Indian consumer is that they are moving towards luxury and stroke premiumization. While luxury is a very niche segment, premiumization is something which is very aspirational, and that is where I think Titan has managed to strike the right chords. The jewelry business is just doing phenomenally well, and they're gaining market share largely because of their store appeal or largely because of the emotional quotient which they are now enjoying. Now, what do you see in Titan going forward? I think next 12 to 18 months I think are good for the cycle per se. Because of the unleashing of jewelry demand and which way things are moving. So I will not be surprised that the stock continues its outwards trajectory, even though it is in and around its long-term average in terms of premium. Now just imagine that so many stocks are trading way above its premium and are lagging growth. Titan is giving you visible growth and the valuations are not way off. Second, right now markets have a love affair with Tata companies. And the P multiple of Trent or Indian Hotel, or even Tata Motors or even TCS, I think Tata companies are enjoying supreme P multiples. So that wave is also there. That markets are deriving comfort from Tata group of companies. Trent P multiple almost 100, Titan P multiple 60 times, Indian Hotel P multiple 30 times, TCS P multiple 25 times. So there's a trend which is at play here. So that is what you need to accept.
Yeah, and since we're talking about Tatas and Titans, who better than Bhaskar Butt to talk to us about how the consumption wave is actually trending. Of course, he's now holding his positions at Tata Sons instead of Titan, but listen in to what he has to say about the consumption and retail wave in India.
If you don't grow in India, you're not relevant. It's by how much you grow, that is, are you at least ahead of the GDP growth rate? Are you ahead of the category growth rate? Are you ahead of the industry growth rate? Those are the questions to ask. So if I were to take lifestyle retail in the group, that is just racing ahead in the form of Trent and Titan. If I were to look at FMCG in the form of Tata Consumer Products, if I were to look at pure retail, Chroma, all of these, I think the group's focus and ability to get the model right has improved over the last few years, and we are racing towards dominating or at least leading in each category. If I were to take airline, which is not really consumer, you can call it travel, it's a big bet the group has taken, and we will get it right. And the opportunity in travel or in hospitality, IHCL, these are all staring us in the face, the multi-decadal opportunity.
All right, that's the latest coming in. On that note, we'll take a very short break. Stay with us. Lots of stocks and news that we'll be discussing when we return. Who joins in with his take, and Sanjeev can't help but do a double take. We were talking about some of the cable players this year, and if you look at the kind of returns that have been shelled out by something like a KEI Industries, it has been absolutely phenomenal over the last 10 years. The bulk of that, say, has been resulted in the last 5 years or so, and with reports talking about a big beneficiary, being a big beneficiary from the infra push. How would you like to, explain or give your analysis on the likes of a KEI, RR Cable, Finolex, Polycab, etc., with the kind of valuations as well that they command?
Yeah. So good morning, Avan. So you had to take it with a little pinch of salt that these stocks and their valuations were unjustified for years. And now the real unbundling is coming, where you realize that these are very, very strong plays. and there is a handful or clutch of players with a demand which is surging, and that's across the board, whether it's wireless, telecommunication, and infrastructure. As a disclosure, Finolex and Polycarb are two stocks which are in our portfolio, but from much lower levels. But we still think this whole gamut of infrastructure stroke ancillary plays on telecom, on the whole 5G network relaying, on the underlying, you cannot have Tata Com, which was trading at 500 rupees, now at 2000 rupees. It is all the underlying assets which have done well, and demographic premium playing out to its best. So, like I said, these stocks have seen very, very sharp run-ups. They are slightly expensive, but you have to factor in 1 year of earnings into them.
Sure, Mr. Bhasin, we were just discussing the retail story and the kind of value creation Tatas have done there. If I had to ask you one pick from Trent versus Titan, which stock would you prefer?
It's a difficult choice, Anisha. Titan is in our portfolio, and we continue to think that is a cheerleader as far as the whole gold and the ancillary sales of. There are four. I don't know how many lakh weddings which are slated, and those weddings have a budget of 4.5 lakh crore. Titan is the biggest beneficiary, and I used to say this before Diwali when Titan was trading below 3,000. If you recollect, that Titan is going to be the biggest beneficiary, and it's it's the underlying business which the Tatas have foregone. Have unleashed that where you have a total transparent earnings company. Generally, gold loan and gold sellers always had that bit of cash level and so on. But I would go with Titan, and like I yesterday also suggested, I would go with Reliance Retail. I think their base product of investing has played out. Now the returns will come back-ended, and that could be the unleashing for Reliance over the next few years.
Sure, and yes, it was CAIT yesterday who said there are 38 lakh marriages lined up in India, and that could bring in fresh spend of 4.75 lakh crore rupees. So that itself could be a big fillip for such stocks. But just shifting focus, Naresh, and coming to you on a couple of these charts and stocks which will be in focus. TCS, of course, will be in focus on account of that $125 million provision that they'll be taking in Q3. Remember, this would mean that the profitability on a quarterly basis might be hit by around 7 to 8%. And if you look at the annual profit, this provision is equivalent of almost 2% of the company's annual profit. So that's the kind of nick that we'll see in companies' EPS estimates as well. And the other one which is going to be in focus is IIFL Finance, because they came out with their FY25 guidance. They are working with a profitability expectation of 2,500 crores by FY25 and the AUM growth of 25%. But on the charts, Naresh, should one buy the dip in TCS? And for IIFL Finance, what should one do?
So for TCS, the case is it's gone sideways for now. If we look at the prices, it was at the same price back in, say, June, July of 2021. And in the last, say, 1 year, every time the stock has come closer to 3,600, 3,650, it has faltered. It faltered in the start of the year a couple of times, and also in August to October. So the case is at current levels, there is a bunch of resistances around 3,600, 3,650. So the risk reward is not great here, but closer to 3,350, 3,400 could be a risk reward buy wherein one keeps a stop loss below 3,330. And again, expect a slow and steady move towards 3,650 level. So more like a defensive bet here, not really a good trade in terms of momentum. On the other hand, IIFL Finance is a stock which is interesting on the longer term charts. Give a good breakout move above that 530 mark before. Went up to 680. Any dip closer to 530 to 570 is a long-term entry point for the stock. Longer-term trend is still very positive out here. So would look at it as a buy on dip if it comes closer to that levels. At current levels, it's consolidating.
All right, stay with us, lots more to talk about, but in the meantime, there's lots to discuss as well by way of individual stocks. And TVS Motor actually has been on a long winning streak for the last 8 months, and incidentally is the top gainer as well within the auto index for 3 straight months on the chart. What is fueling this gain in TVS Motor? Let's understand a little bit more. Srishti joins in. She tracks the sector and joins in with some analysis. Srishti, what's fueling the move?
Well, yes, the stock of TVS Motors has been on the roll. This is the 8th straight month where we are seeing TVS Motors giving a positive return to its shareholders. And not just that, in the past 3 months, the stock is the top gainer in the Nifty Auto Pack. What has led to this rally? So let's decode that, and 3 main factors emerge. Firstly is their resilience in the export market. Given all the turmoil that we have seen in the international markets, the market share of TVS Motors is quite resilient. And if we take a longer view, so we will actually see that TVS Motors has gained 150 to 200 basis points of market share in the last 3 years, and especially in the markets of Africa, especially Nigeria. Other than that, the second biggest factor is their resilience in the financial performance, because this is the 10th straight quarter that we are seeing TVS Motors posting a margin above that 10% mark. Do remember that between this period, we have seen the raw material prices shaping up in quite a volatile fashion. And the third biggest factor is their roaring success in the iQube electric scooters, because if we see their EV sales, the company was bang on track, where they have said that 25,000 in production they will be achieving in the second half of this financial year. They have done that. But in terms of the retail sales as well, that have seen an improvement of 2.5% on a YY basis in the month of October, and 2.2 times that has grown on a YTD basis. But one of the near-term factors is also the Ola Electric IPO, because market is giving it a valuation of over 43,000 crores. That's as per the latest round. And TVS Motors, where we see the electric contributing just 8%, some of the analysts did believe that there was some headroom for further valuation. But the key question is that given the stretch, how are the valuations stacking up? So TVS Motors has been trading at a premium valuation. 1 year forward, we see that trading at around 34 times in comparison to Bajaj Auto at 21 times, and even Hero MotoCorp at close to 16 times. So there is quite a gap in terms of the valuation, but 58% of the analysts at Bloomberg still go ahead with a buy rating on this particular counter. But key to note is their 12-month target price. That stands at around 1,692 rupees. That is like 2% down to the closing of TVS Motors. So these are the factors at play for the company.
Okay, thanks so much for neatly summarizing all of that, Shrishti. What's your verdict, Mr. Bhasin, on this one? Our technical experts, Kunal, etc., believe Hero is better placed than TVS, and even if you go by the consensus estimates on Bloomberg, looks like the upside is now capped on TVS.
Well, Anisha, that's what everyone has been saying for the last 6 months, but the stock has only been going higher. So, there is a bit of froth maybe on the valuation, but, big is always beautiful, and that's why markets chase new highs. Now, I'm not making the case that TVS is a must buy. Like you said, I go with Kunal. I think Hero has undergone a huge transformation. I still like Bajaj Auto, but I would go with more defensive names. Ashok Leyland in the four-wheeler has been my top pick. I still think Eicher, even though there was talk that Triumph and Harley will take market share, I think Eicher has a brand of its own, and it's doing brilliantly. I mean, all kudos to Siddharth Lal. But I would go with Bajaj Auto and Hero. I think, like I said, TVS on technical levels and on the setup which they have can go higher. But if you're a retail investor, then it's better to buy a basket of stocks rather than just one stock, because right now the valuation may not be in your favor.
Okay, so that's the take coming in. The other one I want to discuss is consumer durables. Of course, real estate stocks have seen a massive surge, but if you can pull up the twin charts of Voltas versus Blue Star, you'll see that Blue Star has managed to actually eke out gains of almost 60-65% this year versus Voltas, which has pretty much been flat. What explains that, Mr. Bhasin?
Yes, see, Voltas had to undergo a lot of changes, and I would still say that Voltas has been an underperformer for the right reasons. But look at 3 things. One, their market share gain on the air conditioner side. Secondly, Anisha, not many people know that they have a 25% market share in cooling towers in the Middle East. And if L&T is surging because of that, then Voltas is also not getting a fair amount of distribution there. Thirdly, Tatas want to make that the face of their consumer, facing arm, which is on the customer side. And I think that the valuations are still reasonable, given the brand name and the pedigree of Voltas. So if you measure in that Middle East cooling tower business, the whole setup over there, which is almost 20% of their orders, then I think that Voltas can still head higher. We have a buy rating and accumulate. We think this is headed to 1,100 rupees over the next 1 year.
All right, just taking a look as well as to, the recent trend of FPI selling that we've seen, and that has been in 3 sectors in particular: financial services as a space. There's also been IT, as well as some of the fast-moving consumer goods. Sanjeev, if I were to just pick up on one of these, and with respect to the consumer goods as well, how is it that you would look at, the fact that maybe festive demand wasn't quite as strong as one anticipated, inflationary concerns continue to, remain a huge concern. What would be your outlook in terms of cherry picking perhaps stocks within this space?
So Avan, see, the market is all about sectoral rotation. If you saw yesterday, reality and pharma have hit multi-year highs. Now, I'm not justifying that. So that is at the cost of some sector or the other. Valuations in the consumer space were always expensive and will remain. But like I said, there is a churning of stocks. And when you churn with no fresh impetus of capital, then obviously one will lag and the other will perform. I still think the guidance Nestle gave, the results they've given is going to see that gain market share. I like Godrej Consumer a lot over there. As a disclosure, both these stocks are in our portfolio, in our consumer division, and we think they can be outliers against a Lever or a Colgate or a couple of the other names. We still think Nestle and Godrej Consumer will be the better market performers over there. You can add a Colgate. Actually, I meant to say Colgate is a buy. But like I said, there is sectoral rotation. Pharma and reality are seeing much more delta. And that is what you have seen lagging in the consumer space. I still think the wedding season and the impetus going forward with the festive season will see these stocks, regain their momentum. But like I said, earnings may have priced in the best for some time.
Colgate is up 40%. I didn't realize it actually. Let's look at Patanjali. And it's the other way around. The Patanjali Foods, by the way, but the oral care business, which is Dan Kranti, their biggest brand, that's out. And that is out of Patanjali Foods. Everybody is talking about Ayurveda, health, going organic, but Colgate has done much better than Patanjali this year. Basin Saab?
Bilkul, when I joined the stock market, there was only one stock which investors realized is it used to give bonuses every 3 years. Of course, that time it was 50, 70 rupees. But Colgate has been the best play on India's demographics, the type of, brand they created, and no question about that. There was always this talk that Patanjali will eat into their share and Lever and so on. But I still think there is no stock like Colgate. It has rewarded investors, Nikunj, and it has only increased its market cap. So I continue to stay invested in Colgate. Patanjali is a very, very strong play, and all kudos to Baba Ramdev for being an exceptional, Ayurveda practitioner and a businessman, because he has created value. But like I said, in the Indian demographic, there is room for both to survive. Market will still go with Colgate.
Okay. Patanjali 14%. Actually, Colgate, I didn't realize it, man. I mean, I just did not realize it. And it is so amazing that if you look at the higher flyers of this year, they are the real backbenchers. Coal India, backbencher. NTPC, backbencher. Suzlon, backbencher. The real underdogs who were really off the radar. I mean, folks had stopped tracking them. I mean, Colgate had become... it was not on the radar for most of the brokerage analysts also. And that's the time these stocks have made a comeback. Look at it. NTPC 50%, Suzlon 270%. The year really belongs to the backbenchers. Wasim saab, backbenchers. School की बातें याद आ रही हैं?
बिल्कुल.
You were a backbencher or you were always a good student in the front bench?
Bilkul, I used to be a good student, but because of my height, I was sitting in the back benches and always more keen on what the matches were outside. But Nikunj, that is the unraveling of the market. REC, PFC are up 3 times in the last 2 years. 3 times, 300%. Kisne socha tha power will make such a big comeback? और अभी भी मैं सोचता हूं there is room for appreciation. And if you give me permission, I'll give you one stock which I think is a growth stock which can be an outperformer in 24. However, it has been an underdog of a stock. But we just heard the commentary. We are participating in the management presentation today, and I think that stock investors should have a look at.
All right, Basin Saab, really appreciate your time. Thank you for joining us. Chakri Lokpriya joins us now. So Chakri, we are talking about backbenchers hogging all the limelight right now. So if you're a class monitor, which is the next backbencher which will move up?
Good morning, Nikunj. Yes, it's if you look at the Nifty for year to date, it's up about 8-9%. All the mainline front bencher stocks did nothing. The banking as an index is largely flat for the year, whereas like you rightly mentioned, NTPC and all these companies are actually up 40-50%. So this is partly this new India story which is in the making. And all those new India stocks are actually in the broader market, whether it's power, infrastructure, utilities, all these companies, EPC, infra, cable companies, none of these companies, REC, Power Finance, they're all in the broader market. And they've been a neglected lot. In fact, REC Power Finance is one thing which we got right quite some early on, because it's the same story repeating itself after about 10 years when power wasn't huge, not 10 years. So after 2006 and 7, when power stocks were really hot, and then they went through this whole restructuring phase. And now, so I think, and stocks which never existed before, sectors like railways and defense, those because of the government push, I think that again still has enough momentum.
Sure. Chakri, I also wanted to get your view regarding the IPOs because that's one of the big talking points today. 4 IPOs opening. IREDA is already open till yesterday. It had seen subscription of 2 times already. And today, of course, the big one is going to be Tata Tech. Your view on the recent IPOs and which would be your top bid? Because right now, you're spoiled for choice. You have 5 IPOs which are open. Where do you put your money?
IREDA is in the same space as Power Finance and REC, and in fact, a much smaller player than Power Finance or REC, and it's attractively priced and the trailing about 1.2 times trailing book. And the amount of growth ahead for the green industry, green energy industry, whether it's not just power infrastructure and power, green power, but battery management systems, smart metering, smart grids. That the whole requires a huge amount of capex, and therefore the growth path and therefore the loan growth rates for IREDA, which is a much smaller company from Power Finance, will do really well. Again, Tata Telecommunications, again one of the biggest players. Sorry, Tata Technologies, one of the biggest players in the IT automotive industry, ERD space, growing very, very fast. And that is a higher margin business. It has 2 anchor clients, which is JLR. Some see it as a negative because they are like about 30-40% of their service revenue, but that's a good thing because it provides them with what's the latest happening in the EV business, and therefore that's also a very good IPO.
Let's also get in a take from you as to what the outlook is when it comes to rural-facing companies. Reports seem to be indicating that the demand for the rural front is improving, but the full recovery will continue to take some time. What would be your assessment?
If you look at the volume growth for any FMCG company which rural-facing, it's been 0 to 5%. So the volume growth has not come back. Forget about pricing part. That's not even there anytime, not even there on the radar yet. So I think, that still needs, as far as some of the Unilevers are concerned, they're anyway priced very high. So I think it's still time to go for the volume growth to pick up, the top line growth to pick up for FMCG, which has still not happened. And so I think still as a space, I think we would continue to stay away.
Why has Colgate done so well, Chakri? I mean, it's one of those companies which has got a monoline business, which is only focused on one thing, oral care. They've not moved into any other line of business. Marico has moved out. HUL has got a diversified portfolio. Colgate has just been an oral care company, and they've got challenged by just about every other category player. but yet the stock has given a fantastic 40% return this year.
Indeed, in fact, like what Basin was saying earlier, I think that as the stock has continued to do a few of the things really well, not just in India, but worldwide. When you go into a hotel anywhere around the world and where they have the toothpaste there in the hotel room is usually a Colgate. So their institutional penetration distribution networks are exceedingly strong. And their market shares, they've always maintained their, what do you call that, retail management. As in when you walk into a store, one of the first toothpaste that you would find on a shelf would be all the various Colgate brands. So I think brand management, shelf management, institutional penetration, and of course the company itself has managed its operations worldwide exceedingly well. I think so. There's nothing new they have done, as you rightly said. It's this same old toothpaste, but selling it in new and better ways.
Okay, fair enough. Meantime, Chakri, wanted to also get in your take as to what the outlook is within the entire infra basket. Do you believe that with the kind of impetus to growth that sectors related to capital goods, engineering, infrastructure, cement, etc. are on a general upswing, and where is it that you're finding preference within this space?
The cable companies like Polycab, Nagarjuna Constructions, because they do the construction work. L&T, of course, is the big boy in the business, will benefit. Companies which we never used to talk about in the past, which is railway and defense, whether it's Tataga Wagons or Texmaco. I think Texmaco, in fact, is doing a QIP today. After that fundraise, the company will be far better capitalized and its multiples will look far attractive. And, these companies are not just doing railways, they're also getting into some of the high-tech areas like drones. So the whole infra space is expanding. The definition of infra is changing very fast. And power. Now, for example, IREDA. Now, smart battery management system companies. So this whole space, I think, will continue to occupy a very good amount of investor space because it's still very underrepresented in the indexes and will continue to do very well.
In fact, Texmaco RIL will be in focus on account of that QIP that you talked about. But, Chakri, you also have to take on board that it's a huge bit of dilution that's happening. The company is raising 750 crore with a market capitalization of almost 4,800 crores, telling you dilution is going to be almost 15%, and that's coming in at a discount of 13%. So do watch out for Texmaco RIL if you can pull up that chart. In fact, let me go across to Kunal to get a chart check on this one. In fact, Texmaco, Kunal, what would be your recommendation if there is a dip? And the other one I want to talk about is Raymond as well.
So, TexRail, in fact, many of the railway stocks over the last few weeks have started to show signs of recovery. Now, I think last week I was mentioning that
Kunal, actually, we'll just come back to you because there is some audio issue there. But let me just go across to Chakri and get a sense on Honasa as well. Mamaearth's Q2 earnings will be out today, and ahead of that, that stock was mighty excited. Chakri, your view on the likes of Nykaa and Honasa?
I think, they'll see fairly good earnings, given that the festival season that we've just had. On account of that, there is likely to be a pickup in demand. And therefore, I think the earnings, hopefully for the companies, will be better than expected. In terms of margin improvement, maybe a little bit for Mamaearth, but not so much for Nykaa. Nykaa still has to deal with a lot of very high levels of debt. And I think that is but the valuations for both of the companies are still very expensive.
Oh, the valuations are still very expensive. But back to Kunal on that question of Texmaco and Raymond.
Yeah, so I think I'll start with Texmaco, and that's a stock which has done exceptionally well from 60 rupees. I think just about few quarters back to now 160 plus mark where the stock is 145 plus mark where the stock is trading right now. So again, a very strong move, and I think if there is any kind of a correction like what we saw last month where the stock corrected from 160 to 120 odd mark, that could be taken as a good buying opportunity. So I think railway stocks are now getting into a zone where a buy and dip strategy could be considered to be a very good strategy. Look at how Titagarh Wagon also start to move up higher. I think from 175, 180 odd mark, the stock has now moved into the clubs of almost getting into the 1,000 plus levels for itself. Many of the other railway stocks are also looking attractive. So I think that's one pocket which I would be keenly looking out for, specifically on buy and dips. For the the other names which you mentioned, the likes of Raymond, I would believe that maybe the stock is getting into a corrective wave. I would not be in a hurry to try and anticipate a turnaround over here, because the concern for the charts of Raymond is that it's not just a downtrend, but it's a downtrend which is on the back of complete lack of momentum, any kind of a major rally which the stock has shown. In fact, it's also now getting very close towards breaking below its 200-day moving average. That could dampen the charts a bit more further for Raymond's over the near term. So I would be more of a wait and watch over here.
The stock's done very well for itself. I mean, let's be very clear here. There's a report from Citi on Nestle. We closed the positive catalyst watch on Nestle, which we opened on 13th of October. We thought that the staple demand trends were looking up, and we had a positive outlook on Nestle, but that catalyst seems to be over. Nestle stock, as we speak, is trading at a P multiple of 55 times. Chakri, I mean, at what levels would you start buying staples again? Because they've consolidated for 2-3 years now.
If you look at, I mean, you just mentioned Nestle or even Colgate, all these companies, they're trading at 55-60 times. The ROE to support those kind of multiples is also at about 70-80 times. So they can support those kind of multiples. Now then, what is needed to accelerate those re-rate those multiples further upward is product differentiation. None of these companies have really done nothing much in the last 2-3 years of some brand winning category which everybody wants to buy. There's nothing new which they have come out with. And then on top of that, the rural urban penetration is fairly there. I mean, it's doing at 5-6% growth. Rural income keeps going up and down based on the monsoon. This year it has been weak. So I think these are the factors. There is no those big X factor which will actually provide that extra acceleration or extra push to earnings, and therefore I think it's still trading water.
Fair point. Here's something interesting, and talk about perception and talk about market price is a function of EPS into PE. EPS is what managements always focus on. P is what market gives it. Now let's look at Titan. Titan currently is commanding P multiples which are highest in the industry, 70 times, Kalyan Jewellers 45 times, Senco Gold 24 times, Ethios 46 times. I'm comparing pure jewelry companies here with a watch company here, but just to give you a sense that Titan, even though it's a large company, market cap of 3 lakh crore, for that kind of a market cap to command a P of 70x, I think is absolutely phenomenal. Let's look at some more examples of Tata Group companies. Trent again is trading at a premium which perhaps is the highest in the industry in terms of what the average retail stocks are commanding. You can compare that with DMart, but DMart is a fairly illiquid stock, largely because of concentrated holding. There you go. Now that's TCS for you. We'll come to retail, but that's the Tata comparison in the IT space. TCS is trading at a P multiple of 26 times, Infosys 22 times, HCL Tech 21 times, Tech Mahindra 22 times. Again, the sector is going through a downturn, but Tata Group of companies there again are commanding a very lofty kind of a premium. Consumer names. Tata Consumer does not have the highest ROS, but the P multiple what Tata Consumer currently is commanding is 54x 1 year forward, which is again the highest in the industry, and it is comparable to India's biggest FMCG company, which is HUL. And Trend, well, what can I say? You could rub your eyes and say that Trend is commanding a P multiple of 100 times 12 months forward. So Chakri, it's a trend, but it's a trend which tells you that the belief in Tata Group of companies is absolutely staggering.
Yeah, you're absolutely right, Nikunj. I think they have that brand value. When they do these valuation studies and they assign a certain amount of the overall valuation to the brand of a company, that way Tata has that strength of the brand. Now, individual companies, various companies that you mentioned, yes, except for maybe Trent, because it's done so well for itself in terms of product differentiation, but at 102 times, whether the margins of the retail business support it, it's unlikely. But the others like ABFRL, Aditya Birla Fashions, etc., are all struggling in just getting their product mix right, and therefore Trent has been the winner. Now, as far as the other businesses, now TCS is again the highest margin, being higher margin versus Infosys, or ACL Tech, and therefore it can do that. Now, in terms of Tata Chemicals, Tata Chemicals is now trying to get into the businesses which will help it in the EV space and in providing the chemicals which are necessary to make for battery storage. The chemicals, so that's the benefit. So I think they're doing these various things which will also cater to the new India, Titan. Now, they've diversified their jewelry into various accessories, catering to new Indian aspirations. And so I think, they have been very good in reading the changing face of India.
Let's get a move on then. Chakri, thank you so much for taking time out and joining in. That's the pre-open rate for you at 19,700. The rupee has opened at 83.33, thereabouts to the US dollar. Let's find out what the mid-cap trading strategies are from our chartist. Kunal?
So I think from the mid-cap front, I would look out for, a trade on Pennar Industries. That's a stock which looks attractive. Yesterday also we discussed this on the Chartbusters. I was explaining that the stock is forming a bullish flag formation on the daily charts, something similar which the stock had shown, I think almost 8 to 9 months back. So would be expecting a similar result for the stock, 140 as a target, stop us at 116.
All right, Naresh, let's get in your top mid-cap call.
That would be a buy on KNR Constructions. The stock has finally broken out after a huge consolidation. The stock for the last 1 year made multiple attempts around the 275 to 80 mark. Finally crossed above it, closed with very good volumes. Expecting this to go towards 350 odd levels, stop loss at 284.
Okay, point taken. So those are the top stock recommendations coming in, but talk about the news Fatafat segment and what's happening across the globe. Where Amazon stocks were in focus. They saw a bit of a slip after Amazon.com founder Jeff Bezos is expected to offload more of his stake in the company after selling almost $240 million worth of shares last week, according to media reports. Bezos may sell as many as 8 to 10 million shares, amounting to more than $1 billion. So that's the latest on Amazon. But in a big development, after over 40 days of fighting, Israeli cabinet has approved a hostage deal with Hamas. Israeli cabinet voted for a proposal to release 50 hostages in exchange for 150 Palestinian women and children being held in Israeli prisons and a 4-day pause in fighting. You also have back home the struggle going on in Uttarkashi, wherein authorities are racing against time as rescue operations in Uttarkashi have entered day 11th. After a major breakthrough yesterday, which helped officials to establish an audio-video contact, the operations are continuing on war footing to save 41 workers trapped in collapsed tunnel in Uttarakhand.
Meantime, the Prime Minister Narendra Modi will be chairing a virtual G20 leader summit today. The Delhi Declaration and the ongoing Israel-Hamas conflict will be dominating the talks, which is actually going to see the participation of the Russian president as well as the Chinese premier among leaders from some of the other member countries. And despite the measures by the government, the people in Delhi have no respite from the toxic air. Pollution levels in New Delhi have deteriorated within the very poor category zone for the 4th straight day. On the other hand, the Supreme Court has pulled up the Punjab government over stubble burning cases in the state, and the court has asked the state and the centre to find a long-term solution for the farm fires.
Okay, time now to go across to my colleague Sharad. He's standing by to tell us what's the khabar on Dalal Street. Sharad.
In focus, we're having Titagarh rail systems, and the buzz in the street is that the important stainless steel manufacturing is expected to start for the Bengaluru projects. Now, overall, the production and the work is expected to start by the end of next month. Importantly, the first dispatch coming in for the first stainless steel coach is expected to come before March next year. And also, if you look at it, recently the company has been in focus because of an important arrangement with ABB for metro projects. Now, looking at the stock itself, the stock has hit its 52-week high levels, and the commentary from the management has been very bullish on the orders front.
All right, moving on the back of the Goldman Sachs report on the cable sector, some of the major cable companies are in focus as the report is very positive on the likes of KEI Industries and Polycab. Let's hear out Nikunj's take.
For a stock which was unknown now, is now part of everyone's portfolio. 8 rupees has become 3,000 rupees. Now what was wrong when it was at 8 rupees? Well, the sector was not blooming. Now the sector is blossoming. Similarly, Polycab, I mean, it went public late, but post-public, it really had a puffy-duffy kind of a relationship with the market. There was COVID uncertainty. And if you look at, Polycab, the numbers, I think, have just been absolutely amazing. Now, here's my understanding of the business. Look, I think I agree with the Goldman Sachs report. The top line, the entire, trust in terms of macro, government initiative, power, cable, all these are sectors where the capex is going to be very strong. But are we discussing what was yesterday's trend is tomorrow's story? Well, this could be tomorrow's macro trend, but these stocks are unlikely to be multi-bagger from years because there is a cyclicality after 2 or 3 years which will kick in. These businesses are not very strong in terms of return on equity and return on capital, and large part of the re-rating is over. So if you own these stocks, please hold them. But if you plan to buy these stocks, you got to be prepared for a 15-20% volatility. And I think to assume that you will get more than double-digit returns on a CAGR basis from here also would be slightly stretched. These were stocks which HNI investors bought into when nobody wanted to buy them. And now they've become part of everyone's portfolio. So best part of the discovery process is on. Best part of the P expansion is over. Now you have to ascribe only earnings growth, which could be anywhere between 15 to 18%. That's my limited point.
Okay, if you look at the pre-open rates, it's suggesting there is going to be a mild downtick, not by a whole lot. It's pretty much flat as far as the pre-open rates are suggesting, but a bit of a red tinge is what we are witnessing. So what are technical experts guiding us in terms of the index calls right now? Kunal thinks that the dip should be bought into on the Nifty, and Santosh Meena also follows the same thought process, but it's Naresh who's thinking it's better to hold on to your positions. So that's the view coming in on Nifty. The consensus view is tilting towards a buy. Separately on the Bank Nifty, it's also a similar kind of recommendation coming in. Kunal and Santosh are positive on the index, so they suggest a buy, but Naresh is still sitting on the sidelines and suggesting a no trade on the Bank Nifty.
Kunal, if the direction is up and momentum is not there, shouldn't one just buy? Because momentum will come back if direction is up.
Yeah, absolutely, Nikunj, and that's one of the major reasons why I've been bullish on the indices, even though the momentum has been lacking. And we also have to understand that why is the momentum lacking? It's but obvious because many sectors are still getting into that high news flow, high volatility kind of a zone. But on the other hand, you still have a lot of balancing act which the markets are doing, which is a sign of a very mature kind of a market, because when you have lack of volatility on the benchmark indices, some degree of volatility into individual sectors, but then a balancing act which gets played out from the other, from the rest of the market, I think that's generally considered to be a very good sign, because whenever the volatility settles down into those individual sectors, it's time that the index would find its mojo back in terms of momentum. So I think that's one of the major reasons why I'm bullish on the benchmark Nifty.
Naresh, okay, the direction is up, momentum is down. Will this market rediscover momentum in next couple of days? And just be patient. I mean, there is no point in getting disheartened, because historically every time markets have reached these levels, they've reversed. But do you think this time indeed in the month of November and December we are in for a differentiated market?
So in that sense, we are getting the first indications. We've seen Reliance Industries make a move yesterday. If that does a little bit of a move, we go towards the 20,000, 20,200 mark. So we've seen first heavyweight actually take some leadership. Once we start seeing in a HDFC Bank, ICICI Bank, Kotak, or say the IT sector somewhere, then there is a clear possibility that momentum could come in. And the fact is, the momentum is there across the board apart from the heavyweights. So that is not changing. So the problem is the index is struggling, but there is not a struggle in the rest of the markets as such. So watching out for names. But yes, given that the trend is still up, the momentum is lacking, but the trend is still up, and we could see we just need 1 or 2 names to actually take leadership. We've got the first signs from Reliance. If we see follow-up today and tomorrow, then we get into that momentum phase. We are not seeing that in banks as of now.
If there is no Reliance, if there is no HDFC Bank, then Kunal, what will fire?
I think so. Even without HDFC Bank and Kotak Bank, etc., the Bank Nifty still did pretty well entire last year. So there was a point where the Bank Nifty I think moved by 5,000, 6,000 points. That was of course on the back of the mid cap and the Bank Nifty being a lot more vibrant. The PSU basket did pretty well. So I think I'm pretty certain that the markets would find its way in terms of the other larger cap names trying to out participate or outperform many of the other stocks. So I would not be very difficult to answer that which stocks would probably tend to play a balancing out. But I think it's a process which happens. Sometimes, for example, the auto stocks were underperforming, the real estate, etc., were doing exceptionally well. In the last 4 or 5 days, it's the auto stocks which have made a very strong and a dramatic comeback for themselves. So I think it's a balancing act which the markets would probably play out.
Okay, point taken. The balancing act is what the market has to actually deal with. The other space which has been doing quite well is pharma. Nuresh, quickly talk to us about some of the stocks that stand out in that sector.
So clearly pharma has been a leader. We are looking at a new all-time high being hit today on Sun Pharma. So that's a high coming after 8 years. You have Dr. Reddy's clearly showing momentum. Lupin and Aurobindo Pharma not really stopping. We are seeing small breakouts happening even in the smaller names. So we are looking at a Suven Pharma making a breakout today. So a lot of stocks in the Granules India is at a multi-month high. So clearly pharma as a pack is doing well. So time to continue to look at the larger names. Even the smaller names could be interesting. So one could look at a Granules as well as Suven, which look promising. But Sun Pharma and Dr. Reddy's are the bets in the large caps.
Okay, that's the view coming in on the pharma space. But Nikunj, just going by the kind of data that we have with respect to the FII flows, mild respite that we saw maybe last week with some buying, but the FIIs continue to remain net sellers. And you've been talking about how the elections, a predictable outcome will definitely spur flows in a positive direction, right?
That's still about 7-8 months to that. So my sense is that, look, whatever flows have to come in, which in a sense can digest a bit of volatility, will come in next 2 or 3 months. April, May, you may not see too much of flows coming in. So you could actually have a situation where some high risk or high volatility funds which are ready to digest a 15-20% volatility are ready to chance their arm on this market move which could happen because of election. They actually could be inclined to come back either in December or early Jan. Then you got the real funds who want to say, okay, we want to come at higher levels, but we want to come when there is crystal clarity and when there is no political when there is no volatility risk because of the political because of the election cycle. That flow I think will come back only once the election verdict is out. But when that flow will come back, then we are looking at a compulsive flow coming back rather than the optionality of election verdict attached with it. 15 seconds to go. And it appears that we are in for a downward bias, but it's going to be a minor nick or a minor nick there. You got to look at the market again, what we've been saying, look at the market from the prism of the mid and the small cap space, not just the Nifty, because the Nifty is just not telling you the true picture. First rates Wednesday morning, and the first rates are wow, an index of 19,000. If you have a 6-point change, you actually would say it's like a no-go, so to speak. The breadth is looking good, and that I think is important. What is interesting for me is that the power stocks have started correcting. I don't think I'm missing on anything here, but Suzlon is down, Ratan India Power is down. You've got Orient Power Green that is down, Reliance Power is down. IDBI Bank, where it is obvious that the disinvestment which we've been reporting that is not going to go through. It is on the back burner now. That stock, because of the weight of what is happening in terms of the expectation versus reality, that the stock I think has not collapsed, but it is down. But the breadth today in terms of Suzlon, Vodafone, Yes Bank, Orient Green, Reliance Power, all of them are trading with a downward bias. Nothing in the power sector, Nisha, right? But the stocks are down.
Yeah, nothing specific in terms of news flow. It's just, I think, some sort of profit booking because all of these stocks have had a solid run, and that seems to be the nature in the market today. A bit of profit booking, a bit of consolidation. Let's take a look at some of the newsmakers. TCS, that provision hit of $125 million was expected to have a sentiment impact. Yes, we are seeing that on the stock. Texmaco as well, wherein the QIP of 750 crore has been launched at almost 13% discount. It's actually managing to hold up okay. You also had IIFL Finance came up with that FY25 guidance of theirs. It was a decent kind of show in terms of the expectation going forward. Pretty much flat for the trading session. All cargo logistics, wherein the numbers for the month of October did not look very impressive. It was actually down 4% on a year-on-year basis. And the new grow as well, wherein RBI circular impact they had envisaged will not have any impact on ROE and ROA, was also going to be in focus. Polycab and RR Cable and KEI, these are some of the cable companies we want to put the spotlight on. Of course, there was that Goldman note as well that came in, but these stocks had a good run in the trading session yesterday. Not a lot of these big buzzers, to be honest with you. It's Tata Investments, which is up 2.5%. KPR Mill has opened up in the green. You also have CSC, Suven Pharma. These are the stocks which are doing well. KPIT continues to see a slide. It's actually 5% lower. Remember, yesterday that stock had slipped 7%. Today it's starting with a gap down of almost 3 to 4%, so watch out for that. And then BSE is the other one. Within sector, Savan, I think it's only pharma which is standing out. That's at record high level, and some of the energy names because of the Phillip and BPCL, because rest of the sectors, including real estate, is on the back foot.
Yeah, that's the biggest drag today. And then media is not doing a whole lot. And yep, you fagged off financials, absolutely quiet, lingering around the 43,640 mark. Yes, it is energy, auto to a certain extent. But the market's absolutely flat. But take a look at that breadth. That's in favor of the gaining side. So what do you make of that, Kunal?
Yeah, so I think it's an okay start on the index. We are